Good afternoon, everyone, and thank you for joining today's session. Give it a couple moments for everyone to gather. I see the participants just going up, so I want to make sure that I give everyone some time. But thank you for joining today's session. All right, looks like that less than a minute is what we needed. So I appreciate everyone joining today's session. I know on the invite it said Tony was going to be here, but I am filling in for him. So I certainly hope that's okay with you. Today we're going to focus on how to trade longer dated options, also known as LEAPs. LEAPs are called a long equity anticipated product, and they are generally the main difference between a LEAP and any other type of option is purely the expiration period, and that is greater than 9 months. So we're going to focus on how to trade these, when to trade them, optimal environments. They longer dated options, we're actually going to focus only on the buying side, but there is important components that we need to understand, such as an options premium and when to do that and what we have to overcome. And now a lot of time LEAPs are utilized for stock replacement strategies or for hedging. And if you utilize it for stock replacement strategies, you can also do what's called, for lack of a better name, poor man's covered call. So we're going to actually cover that as well, and then get through some details and some real life examples as we bring up the OptionsPlay platform. But if you don't know me, Jessica Inskip, I'm the Director of Education and Product over at OptionsPlay. My job is to create comprehensive education for the masses. So we certainly thank you for joining today. So let's go ahead and dive in. Now, of course, before we go into the details, we like to start with just a quick disclaimer. Know that I'm going to pull up some securities when I pull up the OptionsPlay tool. Those are essentially just for informational and educational purposes only. They are going to, when we provide daily plays or we go through ideas, there's a process that's involved with that. So we just pick a security, know that that process and due diligence has not been done. So it's purely for informational purposes. Don't go about placing trades off of that. No, there's tax, legal, and investment planning advice that this is not. All right, so without further ado, let's dive in. So I want to start with what an option is. Essentially, since we are looking at longer dated options, we're going to spend a time on the buy side. And when we're spending time on the buy side, it's important to know the components of an option and an options premium. So I want to make sure that we start with that, and we'll really focus on that, and that'll give us an idea of everything. And John, I see you there, so I'll make sure we go by it really, really quickly, but just in case. So a contract an option is a contract between a buyer and a seller. The buyer pays for that premium, which means they want it to go up in value as much as possible. They pay for that premium. The seller receives the premium, which means they don't want it to have any value. Their goal on the sell side is for it not to be worth anything at all. The contract, it sounds like it has a lot of legal jargon, and that's because it is a legal contract between a buyer and a seller. So on this example, the contract contains 100 shares of ABC at $100 per share. It has an expiration date attached to it. If it's issued as a call, that means it contains the right to buy. As a put, that means it contains the right to sell. As the buyers, we can execute upon the terms of that contract at any time, whereas the seller is obligated to fulfill the terms of that contract. So just a quick high-level overview. If this is your first time, we want to make sure that we always cover that. Now, as far as an options premium is concerned, it's important to understand premium decay. So when you are a buyer of an option, which is what we're going to focus on today, you want it to go up in value as much as possible. And so a premium is made up of intrinsic value and extrinsic value. Intrinsic value is its executable value, also known as in the money, whereas extrinsic value is time value and implied volatility. So the best way that I like to describe intrinsic value is executable value. So if we have that previous example where we have a call with the right to buy 100 shares of ABC at 100, it has intrinsic value when it has executable value. So what I mean is if ABC or whatever underlying security is well above 100, and that's our goal when we're buying a call, is we want it to be well above that strike price, then that's what it's called, in the money, and it has that executable value. Now, as an option moves closer to its expiration date, it's only worth generally its executable value. And it's important to cover that because options are more expensive the longer dated they are, and that component is found in extrinsic value, which is that time value. So if there is a decaying factor and we're focusing on buying options, it's important to know the components of an options premium, because essentially we're going to purchase more extrinsic value or more time value because these are longer dated options. And that time value is a depleting factor. And by the time we get to the expiration period, which is the day of expiration, your time value will be 100% depleted. Now, there will still be implied volatility, which is the definitional is the likelihood movement of the underlying security moving in either direction. Interestingly enough, within the S&P 500, due to waiting on CPI and for Powell comments, that has increased implied volatility on options contracts. So even though options are decaying, their time value is decaying as they get closer to expiration. Because there's an anticipated event, implied volatility is making those options go up. So that's a really great example that's happening literally right now to give you an idea of those components of an options premium. So that's really important to understand that as we move into longer dated options, because what we're doing is increasing our risk exposure here, but also utilizing it as a stock replacement strategy or, of course, for hedging. And then the way that I love to describe these is intrinsic value is really internal factors that affect the options price. So the component is the underlying security, whereas extrinsic value is external factors that affect that options price, which is time and implied volatility. And so, of course, as we get all the way towards expiration, every bit of those components are only worth its executable value. And that's it. And a very important component to know. So now let's focus again on the basics. And like I said, we'll do a quick review, but now we're going to focus on these two here. So for longer dated options, we're going to look at long calls and long puts. If you've never seen this chart before, it's extremely helpful if you're just introducing to options, or if you've attended all of our sessions. We actually utilize this to build out the Greeks and associate that with every other strategy, which we'll do a little bit of today as well. So long options are purchased for a premium, and they contain the right to execute upon the terms of the contract. Whereas short options, on the other hand, are sold for a premium, and they contain the obligation to fulfill the other side of that contract. And I'm starting with that because what you can see is there is a mirror across this T chart. So the way this is set up, you have bullish strategies on the top quadrants. You've got bearish strategies on the bottom quadrants. And we've got calls on the left, and we have puts on the right. The goal associated with these is, what you'll notice is long options have some similarities. Time decay hurts them, and that makes sense, right? As we went through the options premium, because it's a decaying factor. So therefore, as the option nears expiration, that's going to make the premium deplete in value. And our goal when buying options is for the premium to increase in value as much as possible. Long options also profit from sharp movement in our desired direction, whereas short options have a directional bias, but they can be profitable even if you don't move as much. So we're going to focus on these two today. But of course, as we spend a lot more time on long calls and long puts, it's a great way to focus and understand the other side as well. So I'd love to share the educational aspect with you, if I will. Before we move in and dive into the deeper details, I do want to make sure that's crystal clear. We understand the underlying options basics, if you will. If that makes sense to you, please go ahead and type a 1 in the chat for me. If you need any other questions, answers, please type that in as well. So many ones. Perfect. Thank you very much. All right, so moving on. So let's look at long calls. And this is how everything associates with the Greeks. And what's important to show you the Greeks here is because it's something that we have to overcome and we're increasing our exposure. Greeks are just words for the goals that are associated on this page. So a long call, like we said before, is purchased for a premium and contains the right to buy the underlying security. Anything that is bullish has a positive delta. So regardless if it's a call or a put, delta just tells us our directional bias. So if we're layering in options together, creating a poor man's covered call or creating hedging or things of that nature, delta can tell you your directional bias on an individual strategy or an individual portfolio. So this is positive for a long call. We want the underlying security to rally more than the premium paid, which means we want the option premium to go up in value as much as possible, which is what gives us a positive vega. Because if we have an increase in implied volatility, like we've been experiencing, even if the underlying moves in our desired direction, you could end up in a loss because of the implied volatility is making that option go up in value because of that likely anticipated movement. So that's important for us to know that that's going to benefit us as long option holders, is that volatility exposure, whereas it could hinder us as if we're on the other side selling options. Time decay is negative. We discussed that in detail. So that just means we have a negative theta. And the important one here is the sharp movement. So that sharp movement is what gives us a positive gamma, meaning we need it to move as much as possible. Gamma tells us how much delta moves. And if we have a higher gamma, then that means delta is going to move more. That's the velocity of getting us to where we want to go, if you will. So the destination is a greater delta, a greater gamma is the acceleration that gets us to that destination. So nonetheless, you don't have to memorize the Greeks there, but you do need to know this part right here. So that's the purpose of showing you that. Now, when you have a long call, your loss is limited to the premium paid, and you start breaking even at expiration when you overcome that premium paid. What we need to take away from this when we're looking at long calls, and now we're going to extend this to a longer time frame, and it's utilized as a stock replacement strategy, we have to adjust these accordingly. So since time is working against us, this is where it helps knowing the Greeks. And again, tools are designed to help minimize this. We want to minimize theta decay as much as possible. And theta is centered around at the money options. And that means that we need to move perhaps a little deeper in the money. That way we can still have some velocity, but understanding how theta decay works, it's not linear, meaning as an option moves closer to expiration, theta defines its daily decay value. Its daily decay value is very minimal the longer or the farther out you are from your expiration date, and then all of a sudden just extremely accelerates as we get to expiration. And since that occurs, there's something that happens between theta and gamma. So think about this. If gamma is, went too far there. If gamma is going to tell us how quickly we're going to get our destination, and our destination is profit, there is something called a theta and a gamma trade-off. And I'm unsure if you've heard of that before. And again, that just means the trade-off between time value decay and acceleration of profit. And that's because this time value is centered around at the money options, and at the money options are options with the strike price that is very close to the underlying securities price. And since as theta increases, gamma decreases and vice versa. So that's what's extremely important to know. So what does that mean? So if we have no more theta decay and we're at expiration, we have higher gamma. That makes sense because the option is going to be in the money or not, so on and so forth. So what we need to do if we are going to have longer time frames, we need to, this negative value, the only negative value for a long option, we need to minimize as much as possible. And the way that we minimize that as much as possible is moving away from out of the money options. But by still keeping our gamma, we need to be a little bit closer in the money, which means just increasing our delta or our stock exposure, starting a little closer to the destination, if that makes sense. So we'll go into that with a lot more detail. And as far as row, that's something that we cover, and I can pull up the tool and show you. But interest rates still have a very minimal impact on a premium. They're still there, but it's not enough for us to go into detail, especially for this session. All right. So the goal that I wanted you to take away from this, though, is knowing the negative impacts that are inherent of long options, or in this case, a long call, and what we can do to maximize on that, which is theta. And long puts have the similar Greeks. The only difference is delta is negative, and that's because it's a bearish strategy. That's literally the difference. So the same thing that we have to overcome for long puts is theta. So that's what we're going to focus on, and understanding the value. That's going to help us pick our strike prices. It's going to help define our exit strategy, and so on and so forth. And something that's a little nugget of knowledge that we share in regard to options is we never hold them until expiration. If you hold a long option until expiration, that means you're giving up all time value that you have purchased. And we want to be able to sell to close that before that massive theta decay occurs. And with short options, that just equates to risk, because we're profitable if the underlying security just stays a penny below our strike price or above, depending on what side you are. And so that's why it's very, very important to not hold an option until expiration. It's all about theta, and a lot of leaps has to do with theta, because leaps just means an extension of time. So when would we use leap options? So on the call side, it's when you have a bullish outlook. So we're going to do a replacement strategy for a long security. And that's really, really common. Whenever we are purchasing stock, the most that you can lose is the amount that you invested, right? And so if we're doing a replacement strategy for a long stock, we want to have the same components associated with that. So extending your time frame allows you to have a similar risk exposure, and there are some varieties that we'll talk about in a moment. You have a bullish outlook that's greater than 3 months, because remember, time frame is extremely important, and that's because we're adding another layer of complexity. If we were just purchasing the security outright, theoretically you can hold the stock to an indefinite time frame. However, options have an expiration date attached to it, so that's something that we have to be cognizant of. And so we have a bullish outlook for a specified time frame. Additionally, since it replaces the stock, it can be utilized from a leverage perspective, because you will be spending less than you would in comparison to purchasing the stock outright. And we'll talk about strategies that do that as well. And you can also mitigate some downside risks as far as earnings, the security being overbought, extended rallies, and lofty valuations. From the put side, where this makes sense is hedging your stock or portfolio overall. So if you have a bearish outlook for a certain time frame, in our previous sessions, we talked about utilizing long puts for hedging purposes and even callers and so on and so forth. This makes sense if you are wanting to have a defensive view, but you're unable to move to cash. You don't want to sell. You want to mitigate a taxable event, things of that nature. Then this will certainly help that. Moving on. So how does this affect me as a trader? So the benefits are if we are using this as a stock replacement strategy, you're having limited risk and retaining capital efficiency. You'll still have the same exposure that you would to a stock, and that's the way that we're positioning delta and mitigating theta. And when I'll bring up options, the OptionsPlay tool, I'll show you with some real examples, and we'll compare them side to side with movement on the underlying security and expiration. You are going to spend absolutely less than the cost of the underlying security, but no, benefits also come with increased risks as well. And we'll have relatively low time decay per day because we're going out so far, and that theta decay doesn't rapidly occur until about 14 to 21 days until expiration. Your limitations are you are requiring a sizable move to profit, and that's because we're going farther out, and that's inherent of long options because we need a sharp directional movement in our desired direction. Comparison to the security, buying the security itself, you're not entitled to any dividends, you're not entitled into any voting rights, and it's something that you can't do on all securities. It has to be an optional security. And additionally, they tend to be a little less liquid, which is important to know as well. As far as optimal leap strategies are concerned, so first of all, in order for it to be a leap or a long-dated option, the definition is it's greater than 9 months. This minimizes your theta decay, but your strike price by buying slightly in the money, which is also a 60 to a 70 delta, 0.6 to 0.7 delta, just something deeper in the money with a higher delta, that's also going to minimize your theta decay because it's going to have lower extrinsic value. And that's going to create, so that is how the setup or that optimal strategy is going to reduce the negative effect on long options, which is theta. So deeper in the money, we're giving up that gamma theta risk exposure, if you will. And then in comparing this to side by side from in the money versus out of the money leaps is extremely important, in addition to just buying the security outright as well. Because something that happens when you trade options for the first times, you don't understand how an options premium is comprised. I often find that people like to, or traders prefer to purchase out of the money options because they're cheaper. They do experience gain if there's an increase in implied volatility or the stock does move, but they have rapid theta decay. And so those tend to be day traded, those far out of the money options. But what happens is if you're trading leaps and you have a very far out of the money option, you're giving up your gamma in the wrong way. So that's where gamma is really, really important. And again, it's just a word for how much acceleration your option needs before it can become profitable. So your gamma is going to be really, really low if your option is very far out of the money. It will also be very, very low if your option is very deep in the money because it's already at its destination and it doesn't have any more theta to overcome. That makes sense. So on the out of the money side of it, it has a lot more theta to overcome. So it's you're switched your engine from a Maserati to a bicycle. So you're not going to go very far because you have a farther destination with a terrible mode of transportation, if you will. So hopefully this will put that into perspective. So your stock price at expiration, if you bought 100 shares at $100 per share, you bought an 85 strike call leap for $20. And remember, this 85 is going to be deeper in the money because it's $15 in the money. We've got a right to buy at 85 if it's at 100 here versus there. And then this 110 is $10 out of the money. So this, of course, was cheaper. This one we spent a little more, but it had instant value of 15. Now, because we had our in the money value of 15. If the stock price does not go, and this is an extreme example, in our favor and goes down to $50 per share, we're going to experience a $50 loss on what we purchased at $100 for. It's a dollar for dollar loss. Here, we had $15 of intrinsic value, $5 extrinsic. So we have a $20 loss in this scenario. Here, our full premium at expiration for both of these scenarios. If we purchased the 100 here, we have 85. So again, dollar for dollar, this is still at the money, full $20. So this is another reason why we should not hold an option until expiration, and then full premium here. We'll break even at 100. We have a loss here at 5 and a loss of 5. So you can see the similarities, and now we're gaining more. This is where the important lesson is as the underlying security moves up, this is going to be closer to a stock replacement strategy because it was deeper in the money, which means you're going to have more exposure to the movement of the underlying security and less of that theta movement to overcome. So as the stock goes up in value, you're not going to make as much as you would for the underlying security moving dollar for dollar. However, you are going to have better exposure if you're deeper in the money than if you were farther out of the money. And so that's the purpose of showing you this, is the best practice when you're purchasing a LEAP and utilizing it as a stock replacement strategy, because the goal here is for you to gain exposure to an underlying security without spending as much as buying the shares. You want to make sure that you have as much exposure to that underlying security as you can, which occurs if you choose a strike price that's deeper in the money, which is a 0.6 to a 0.7 delta in this case, or just below the $100, so that time that the trade is placed. So some tips that we've put together. When you are trading LEAPs as a stock replacement strategy, you need to enter and exit it as if you're trading the stock, because it is a stock replacement strategy. So your sentiment, your goal, your process of when you choose that an underlying security is bullish or bearish, that's how you would utilize this strategy. You have that long-term outlook, and of course you're cognizant of the market environment as well. It happens when you're in a bear market, even though you've got something with really great revenue or really great earnings per share, but there's an overall bear market or some unknown macro headwinds that can, of course, adjust your entry. And then always have an exit strategy. And within that exit strategy, you want to exit prior to expiration at a gain or a loss, because you're giving up that theta decay. So the theme of this is the theta decay that you need to overcome. And you can set up a stop loss to take profits based on the underlying securities price. You can create an alert based on the underlying security price, but that's very important to know. And then of course I want to introduce you to the poor man's covered call. So this is where it's an extension, if you will, of the stock replacement strategy. So if you have a deep in the money call, we have our 0.6 or our 0.7 delta. Just like our covered call sessions, the same rules apply, and you can offset your extrinsic value with a shorter term option. So our longer term options, 9 months or out, shorter term, 30 days, 45 days max, that can reduce the cost of your extrinsic value. And then that would allow you to gain more exposure to the stock. But no, if you do that, you are also capping your upwards potential within that time frame. So not necessarily a calendar spread, but this is I hate the name for it, but it's called a poor man's covered call. And in comparison to a covered call, it's important just to understand that is, again, we're using an option to replace stock. So our sentiments are going to be very identical, but our risk and other information are going to vary. So our risk is still going to be substantial, but it's less because we're receiving a premium, but our cost of our long call is less than the cost of the underlying security. You still cap your profit potential, but you just don't have what you would with owning the underlying security, which is access to dividends and voting rights, etc. And a poor man's covered call requires more trade management and margin. This does require margin because you're essentially creating a spread. All right, so now I'm going to bring up the OptionsPlay tool if you don't have access to it, a free access to it if you're in OptionsPlay Canada. So I wanted to put it on the screen, tmx.optionsplay.com, so you can follow along with me if you would like. But now I'm going to go through some real details of looking at longer dated options versus shorter dated options. We'll look at in the money and out of the money, even at the money. So that way you have some real examples and we'll adjust implied volatility from there. So I'm going to stop sharing my screen for one moment and pull that up. But again, it is tmx.optionsplay.com. And you will get a link to the slides and the video when the session is over. I saw a couple questions about that. All right, so here's the OptionsPlay tool. And let's do some comparison and some real life examples. I saw some questions on there. How do I choose an underlying security to place this trade on? So that's really how OptionsPlay is designed. So know that longer dated options are stock replacements or utilized for hedging purposes. We focused a lot on the stock replacement strategy because that is what this is most commonly used for. So with that being said, these are strategies that you are bullish on long term. So to gather ideas, you can utilize this platform. This green bar means that there is a 6-month bullish trend. So this is designed to give you ideas that are on your watch list or that you should pay attention to. You can create a watch list as well. But this is your starting point of securities that you would want to pay attention to. This second widget here is a security, is how you validate that. So we've got some details for you to help you with that process. Have Shopify here. I know we were looking at that last time I did a session with TMX, but it broke out of that trading range. And so I think it's interesting to watch. So by default, this green line, like I said, is the 6-month trend. We try to make this as easy as possible for you. And that's where this tool right here is extremely helpful. So the way technical analysis works is a longer term time frame is considered strength. But normally the shorter time frame is going to switch prior to the longer term. And you can see that here. We have the shorter term. So this is the 1-month trend, and this is the 6-month trend. The shorter term time frame, 1 month started neutral, going bullish. But as soon as both are bullish, then that indicates strength to a trend. So that's the way that we help filter through the noise. And then of course, relative strength gives you that indication as well. But this is a fully customizable chart where you can maximize and add any indicator that you would like. And we do plot support and resistance. And again, this is just an example. Due diligence is always and certainly required. So let's just say for example purposes that we want to go ahead and look at Shopify. By default, we're going to put in bullish, but we want to look at the difference of buying 100 shares versus maybe a shorter term call and the leap strategy. So the way that I'm going to adjust that is I'm actually going to modify this bull call spread to a long call. And to make it a leap, I just need a 9-month or greater expiration. So let's go out to the farthest possible. It's going to cost me a lot more, but that's because we have as close to at the money that is possible. And we know that we need to make this a deeper in the money option. So deeper in the money just means we need the strike price to be lower than what it's trading at. We also have delta here. So it's a reimagined option change. So I'm going to look at the 0.7 delta. So that's what you see here is this is the premium. So we have the strike, the premium, and the delta. Purpose of this is all of those Greeks that we were talking about in the beginning are what's utilized to pick strikes and understand your movement. So this is designed to bring what you need to filter through in front of you. And at this moment, we need to focus on delta. So that's how this option chain is comprised. If they are a little illiquid, I definitely want to make sure that we specify the midpoint. So we've got 46 at 14.75. This is an at the money, and this is versus buying 100 shares. So let's just compare and contrast as far as what happens with the P&L simulator. Now, if we're completely wrong and this security goes down in price, you can see what happens from a loss and a return perspective. But I want to take a step back because we talked about an options premium and how it's comprised. That's why these three factors in this P&L simulator are extremely important. We have to have a destination where we feel that the underlying security is going to go. This is its intrinsic value. So it's just another word for where you feel the security is going to go. If it has executable value, it has intrinsic value. By this date is going to take into account your theta decay. And we know that we don't want to hold an option until expiration if we're purchasing it, because that means we're giving up our theta decay. You could, of course, give up, there's always a risk versus reward, a lot of upside potential if it really moves. However, you are still giving up theta decay. And then implied volatility is very important as well, because that's the other component of extrinsic value. If implied volatility increases, that makes options go up in price. Isn't going to do anything to the underlying security. Well, it tends to, the supply and demand does, but I digress. It's going to make the option more expensive. So we need to know if we expect a movement in implied volatility in either direction. And that tends to happen around events. So very, very important to know there. So without further ado, our cost is of course going to be the most for buying the shares. It's going to be less for a shorter dated option, and it's going to be more for a longer dated option. But we adjusted this and we have something that's deeper in the money. Now, if we're completely wrong, we're limited to the cost paid for every single one of these. This one just has other factors associated with it, and that is the options. If this goes up in value, all of these have unlimited profit potential. So they're going to make up rather well, but realistically, this going to 128 by February 17th is unlikely. So we don't want to plan for unlikely scenarios. We want to skew risk versus reward in our favor, and of course have a outcome that is more realistic. So perhaps we feel that this will go maybe to 75. Can adjust from here. You can see how the profit potential adjusts for the security. And if implied volatility was to increase, we can see how that adjusts as well. Now, we may want to reduce our exposure, or perhaps to say, okay, this is going to make more money in the short term if it goes that high, or maybe I feel it's not going to go as much. So that's where this tool is extremely helpful, and where the word OptionsPlay got its name. Is you have to focus on risk versus reward in order to be a successful options trader. And you want to make sure that you skew risk versus reward in your favor. And the great way to do that when you're trying to understand an optimal options strategy is by understanding risk versus reward and focusing on that. And that's what this tool allows you to do, is compare strategies side by side. We could compare various leaps. We could compare, just like we are right now, buying the shares versus a shorter term option, so on and so forth. And we also looked at all of this by expiration, and that's where this is important. We know that we're not going to hold an option until expiration. Unfortunately, because we have the shorter dated option, we're going to have to go, well, let's go to the shorter dated options time frame. It's the 15th. So we should see a movement here. And understanding that time value component. And that's what's important to see here. Do we want how much exposure? What's our time frame? So on and so forth. All right, so that was a high level overview. There are a lot of tools and resources here. Like I said, you can extend this to the poor man's covered call. We can adjust that. I saw a question in there about the OptionsPlay score. What that does is take into account all of the items that you find here. So your cost, your reward, and probability of profit, and assigns it a score. So those are intended purely for starting points. And then you can, of course, adjust from there. We've got a couple of minutes left, or about 15 minutes left. So I will open it up for questions. I see a lot that came in the chat, so I'm happy to do that. And if you have any more, please feel free to put those in the chat or in the Q&A window. And again, thank you again for taking the time to attend today's session. Leaps are certainly something that can be utilized, but it requires you to fully understand how an options premium is priced. And the first step is always education. So thank you for taking the time today. Yes, you will get the recording for this session. As long as you signed up, it will go via email. You'll also receive a copy of the presentation as well. All right. Scrolling through the questions, so I apologize if I'm quiet. How does VIX work? I mean, I love that question so very much. Why not answer it? So, but that's important as we're talking about implied volatility. So the VIX utilizes all liquid options that are 30 days out for the S&P 500. And since it utilizes those 30-day options that are out for the S&P 500, it's a look of 30 days forward. And that's why sometimes you can see the market or the S&P 500 in this regard be up, and then VIX also up, because it's looking at a 30-day period. It seeks to do 30 days. So it ends up being 23 to 30 days, but it measures that extrinsic value component and implied volatility. So if there's a lot of movement in one underlying security, that can make implied volatility go higher, which makes an adjustment, and we could expect more movement. So think about how an options premium works. If you're more expensive, the option is because of implied volatility, the VIX is going to be higher because there is expected more movement. And that movement normally is to the downside, but it could also be to the upside as well. And what's interesting is looking at the calculations of something like vol-Q in comparison. So vol-Q is an index that just uses at the money options. So the calculation is really very similar, but instead of utilizing all options within that series, which is that 30-day series, it just looks at the money, which is where theta is centered. So in my opinion, that's a little more accurate depiction of volatility. When making an options trade, is one of the Greeks more important than the other, and are they all important to follow? Rick, it's not necessarily that there's one that's more important than the other. The Greeks are, just like option, a name for a lot of different things. And so this tool is designed to take components of the Greeks and put it in a much more visually compelling and easy to understand manner. If we go into one trade, for example, we should be able to read the Greeks and have a better view of it, which is right here. So what's important to know about the Greeks is if you're trading a lot of options, I've seen some people who only trade Apple, for example, and they have 30 different strategies. You may want to know if you have a directional bias. So that's where it's just taking that next step of complexity and understanding if you're bullish or bearish. Delta, I think, is probably delta and theta are probably the most important, because we utilize delta to understand probability of expiration, or probability of being in the money on expiration. So today we said choose a higher delta because you have a higher probability of being in the money on expiration, because we're on the buy side. But if we're looking at selling options or covered calls, for example, we would say you need a 15 to a 20 delta, because we want to prioritize capital appreciation and need more movements. So Delta gives you an indication of how deep in the money something is, how far out of the money it is. That's the destination, if you will, when you're buying options or in options in general. So it's important when choosing strike prices, but this tool does that all for you. So it's a nice to know. Theta, it's just important to know that I think theta would probably be the second most important, because you just need to know if time benefits you or doesn't. So you don't have to know how theta works, but you do need to know if you're buying options, you're also buying time, and you need to overcome that. Whereas if you're selling options, you're selling time, and you need to get out of that position before that moves out of your favor. That's really all it is. The Greeks can be so polarizing, but it's really just understanding the effect on your options premium. That's all you really do need to understand. Thoughts on lack of volume on TSX stocks versus NYSE or NASDAQ names? I think that's a wonderful question, Vic. Well, that's because TSX, the volume is picking up more, but in the States, I guess from an options perspective, at least, there is a lot more traders. We have had some interesting trends and there's a lot more availability, but going through TSX and TMX's data, there is a lot picking up, and volume is extremely important, yes, but when on the options side, you just want to look at execution and execution quality, and that looks really well. But what I've noticed from diving into the data in the Canadian markets versus the UX, it's really picking up in trends, almost very similar to the way that the US was really the beginning of the pandemic around 2020. So I expect to see a lot more volume in the near days. And it's also access to market and traders and culture in a way. Do you calculate an expected move for your trade? There are certain ways to do that. So you could utilize a standard deviation to give an idea of your expected move. I think it's extremely helpful to do that around earnings, where you can utilize an at the money straddle. That's an anticipated move. And you can do that at any time. It doesn't have to be earnings. But yeah, I'll absolutely do that in some instances, just from an understanding a directional move for the underlying security. But if I'm looking for where I feel a security is going to go, once I've done the fundamental side, that's where technical analysis is extremely helpful. Just areas of supply and demand. For example, this is right here for Shopify. That looks like an area to overcome, because that's what a very large stopping point. And if a stopping point is overcome, then it becomes a supporting point. So support and resistance are very helpful, but that's where I absolutely layer on technical analysis. Would you recommend a stop loss as a % of overall portfolio value, or stop loss as a % of each trade individually? Absolutely, each trade individually. Because that's a really great question, John. There are two ways to look at that. So we do want to think about our exit strategy and our entry strategy, and that absolutely equates to the risk that we're willing to take on. So from a portfolio level, it's a certain threshold that I would use on the entry side, meaning I may not use more than 2% of my portfolio on any trade. That's going to help you mitigate risk, because we're going to skew risk versus reward in our favor. Meaning, if I'm buying an option, I want to make sure that I can make at least 3 times. And if I do that, I know that there's no magic formula out there where I'm going to win on 100% of my trades. But what I am doing is setting myself up for success. I'm not utilizing my entire account. So if I don't win on that trade, you're out. That's how people blow up accounts. But what you are doing is, in the words of Tom Sosnoff, trading small and trading often. You're having tactful risk allocation on the portfolio side, utilizing that 2% rule. And then that allows you to then enter a trade tactfully with that 3-to-1 risk reward ratio. And then on that trade itself, there are best practices that I would apply. And we go through those in a lot of detail. There are best practices that are different on the entry side for long options, and they're different for short options. And that as well includes taking losses and taking gains. but that is a wonderful question, and it's great to focus on risk versus reward. The delta in the Greek section in OptionsPlay seems to have a different meaning. Tim, you are correct. Delta has about 4 different meanings. So there are so many ways to utilize delta. It's the most versatile Greek that's out there. The way that we display it in the platform here is the definition of the Greek or of the of delta is as the underlying security moves $1, how much will the options premium move? And then remember that an option contract, one contract represents 100 shares. So what this is saying is as the underlying security moves up $1, your equivalent of representation of 100 shares is going to go up $57 in value. So that will also give you an indication. You can see how that would tell you your exposure to the stock. If you have a higher delta, if the underlying security moves up $1, this is going to be a higher number. So yes, it's showed differently because there's a lot of ways to use it. Delta is certainly a fun one, but these are all their definitional perspectives and then shows them to you in a different way with some smart text that's easier to understand. All right, I think we covered most of the questions there. We'll go through the Q&A as well. Andy, if I want to reduce the volatility of leaps, does it make sense to buy lower delta if it takes 2 years out? Well, if you have a lower delta, though, you don't have the same stock exposure. So we want to have theta exposure. So we want delta exposure. So we want to have a higher delta. You're right. You're going to have, well, implied volatility in Vega is actually higher for leaps. They're a little more sensitive. So that wouldn't even mitigate that. So if farther out of the money means you have a longer way to your destination, and the purpose of leaps is really a stock replacement strategy, which means that we need to be a little bit at our destination, which means a higher delta. Delta of 0.5 is at the money. So anything that is lower than 0.5 means that it's out of the money. Vic, we covered which stocks would be ideal, which is through this security, but again, it's something you're bullish on. Vic says implied volatility in the range bar when determining targets and how it impacts profits. So implied volatility, if it increases, will make your option premium go up in value. And that's this very interesting phenomena that's happened with those SPX options I was talking about earlier, is because we're waiting on this Fed decision and waiting on Powell to say, and even before CPI came out, there was a movement. We knew that the market was going to move drastically in either direction. And ironically, it really didn't, but there was an anticipated movement that made the options more expensive. And because that made the options more expensive, even if you were on the short side and the underlying security for a short call, for example, a 40/60, if the underlying security was right below that, that's technically where you would be profitable. Even if a couple weeks went by, you should have experienced theta decay. But what happened is you had an increase in implied volatility. So you might have broke even or even ended up in a loss scenario because something that makes the option more expensive was occurring. So that's how you kind of balance those macro versus micro, or no, that's why you need to know when earnings are coming up, because that's going to increase implied volatility for an underlying security. And that's why we also have it here and on the strategy checklist. If you were to hit this trade button here, we'll let you know when the earnings date is, so you can be cognizant of that implied volatility activity. And that also goes on the tail end. Implied volatility depletes when those events occur. So after earnings, for example, the day after February 15th, any implied volatility or anticipated movement that was built in for Shopify is going to be gone. So if you purchased with that increased implied volatility, you'll experience what's called volatility crush. and that could end up hurting you on the long side. All right. Okay, I think we covered most of those questions. This is the last one that we're doing for TMX for the year, so I really do appreciate everyone's attendance and the engaging conversation. We definitely really want to promote education at OptionsPlay, and being a successful trader starts with always learning. It's part of why I love options, is because there's so much to learn and so much that happens with the market. So it's certainly a really interesting subject. So thank you for your attendance today. Like I said, please feel free to utilize this tool. Any questions or concerns, let us know. And I thank you. And I hope you guys enjoy the rest of your year. Have a wonderful holiday, and we'll see you soon.